Good morning, everyone. Thank you for joining us this morning on the webinar with Graeme Chaplin. Graeme's the Bank of England's agent for the West Midlands. The bank's a network of 12 agencies across the UK, acting as its eyes and ears across the regions. Graeme spends the majority of his time speaking to businesses from all sectors and of all sizes. The information he and his fellow agents gather form a vital component of the monthly decision-making process for the Bank of England's Monetary Policy Committee. Graeme's worked at the bank now for over 30 years. In a varied career, he's been a bank supervisor, an economist, and a financial stability analyst. He's been the bank's agent in the West Midlands since autumn 2008. So I'll hand over to Graeme for the presentation.
Smashing. Thanks, Paul. Thanks for the introduction. Thanks for having me along this morning, everyone. Yes, the plan for this morning is that I'm going to take you through my presentation, talk a bit about the role of the bank, because I think it's an institution everyone knows, but quite often people don't understand precisely what it is that we do. So I'll give you a bit of a flavour of that. But what I'm going to focus on is where we think the outlook for the UK economy is currently, where we think the big questions are, where the big things are that we're scratching our heads over in order to work out how to set interest rates in order to hit our inflation target. And then at the end, I think Paul's going to ask me some tricky questions. So looking forward to that. So, yes, I'm the Bank of England's agent for the West Midlands. I'm the eyes and ears of the bank in the region. And yes, I spend all my time speaking to businesses, trying to find out what's going on in the real economy, feeding that information back to decision makers in London. So whether that's the Monetary Policy Committee setting interest rates, or the Financial Policy Committee looking at the ecosystem of the financial sector in this country and making sure that it's fit for purpose. So can I have the next slide, please? So the bank, who are we? What do we do? Well, we've been around for a very long time. We were founded back in the late 1600s in order to finance a war with the French, as it happens. But we've been part of the public sector since the end of the Second World War. We are independent, but you, via the government, set our objectives. So we're accountable to Parliament for what we do. It's Parliament that decides what we should do. Big picture. So, for example, they set the 2% inflation target that we have to hit. But day-to-day decision-making on how we hit that target or how we ensure the financial system is stable, that day-to-day decision-making is ours. And we are totally independent of government when we take those decisions. And our mission, as it says here, is to promote the good of the people of the United Kingdom by maintaining monetary and financial stability. And hopefully, by the end of this presentation, you'll have an idea of what that actually means in practice. So, one thing that most people know about the Bank of England, of course, is that we have a nickname, which is the Old Lady of Threadneedle Street. So I always think it's good to start any presentation with an 18th century cartoon. So next slide, please. So here we are. Here's your daily 18th century cartoon. This is the Prime Minister ravishing the Old Lady of Threadneedle Street, the Bank of England. She's the one on the left, by the way. And her dress is made of banknotes, and the Prime Minister, William Pitt, is trying to get his hands on her gold, which is in her pockets and also in that big chest she's sitting on. So this is how we got the name. We got the name as a result of this cartoon. It's a bit more interesting than that, because it's about confidence in money. That's what we're all about. And the reason this was such a scandal and that there were cartoons drawn about it was because the government at the time took us off the gold standard. So they stopped banknotes being convertible for gold. And they just said, we're going to use paper money. And at the time, everyone thought this was a terrible scandal and that you couldn't have money that wasn't backed by gold. And it was seen as, the government taking leave of its senses. And funnily enough, William Pitt wanted to do this, of course, to fight at war with France. This seems to come back again and again. Whereas now, of course, we think paper money, plastic money is proper money. That's money. We don't expect to be able to walk into the Bank of England and exchange it for gold coins. So it shows how things change over the years. And now there's a big debate about whether we should move to purely digital money and not have to worry about notes and coins at all. And again, people are up in arms about this or concerned about it, and in some cases rightly so. But it's these things change, and it's all about maintaining confidence in whatever form of money people find most convenient. That is what is at the heart of what the bank does. So next slide, please. So there you go. What we do is we maintain trust in money. So how do you do that? Well, you make sure banknotes are really difficult to forge for a start. If you're interested in that, there is absolutely a ton of stuff on our website telling you all about how difficult it is to forge a plastic banknote. We set interest rates. We use monetary policy to target low price inflation. And of course, that's vital, because if you get high inflation, the value of your money just, completely collapses, and it can happen very rapidly. And in that kind of world, you don't want to hold government money. You want to hold something else, whether that's gold or, cigarettes or, another currency from a foreign government. We also have to make sure the banking system is nice and safe, because you have to be confident that money you put in the bank is still going to be there when you go back to draw it out again. And that's fundamental. So we regulate the banks. We got regulation back after the global financial crisis in 2008. And since then, the banks have become far more robust. So the plan being that when there are slowdowns in the economy and shocks, the banks are there and remain resilient rather than becoming part of the problem as they were back in 2008. And then finally, we look at the entire financial system as well. As I said, we look at the ecosystem of finance. And we have a financial policy committee whose job it is to worry. They're paid to worry about where the next risk could be emerging in the financial system. They publish a twice yearly report listing all their worries and thinking about what we might do in order to make things more robust. And their particular worry at the moment is non-bank finance. So the finance provided outside the global banking system, and whether that's getting overheated. So they're watching that very carefully. I'm going to move on to monetary policy in a second, but I just want to do a quick bit of publicity. So next slide, please. There you go. We've got our new King Charles banknotes coming out at the beginning of June. So, you can rush out and get those from your nearest ATM on that date. Though actually, there'll still be plenty of notes around with the Queen's head on them for a long time to come, because we want to make sure we're doing this in a green way, so that we're not going to take all the Queen notes in and destroy them and then replace them. We're going to let them have their normal life. But anyway, King Charles is coming to a banknote near you shortly. Next slide, please. So after that short, publicity intermission, let's get back to the main narrative, which is all about how we set interest rates in order to hit the inflation target, which is 2% on the CPI measure of inflation. Next slide, please. So here's the Bank of England, and in there is where the Monetary Policy Committee meet 8 times a year in order to set interest rates. So how do they do this? Well, there are 9 members of the committee. 5 of them are bank employees, 4 governors and the chief economist. And then 4 of them are external appointees appointed by the Treasury, who are technical professional economists. And they come from typically an academic background, and they come from all over the world. So they're meant to be kind of leaders in their field. And they are all individually responsible for their own votes on where bank rates should be going. So they have to give speeches, they have to go into Parliament and justify the decisions they're making. So it's very much one person, one vote. It's not groupthink at all. There are divisions quite often on the committee. The idea being that, economics is as much an art as a science. If it was a pure science, we'd just have a computer doing all this. There's big room for debate and discussion about where you're going to put interest rates going forward. And that's what we do. They have, of course, a team of economists in the bank working with them, who come up with a forecast for where the economy is going to go over the next 3 years. And that's really important, because when we set interest rates today, it affects the economy with a lag. So it's going to take 6, 9, 12, 24, 36 months for those changes to come through in the real economy. So you need to have a view on where you think the economy is going over that period. So whilst we know, of course, that our forecast will not come to pass, we do not know what's going to happen in the future. It's important that we have a forecast, we have a best guess of where the economy is going, in order to make sure that we make the best interest rate decisions that we can, given what we know about the current conjuncture. Sorry, I've just lost my slides on my own screen, so I'm just trying to resuscitate them, which is a bit irritating. Hey, right, I'm back. So, yes, we can have the next slide, please. So, we have, of course, been raising interest rates pretty rapidly recently, as you can see from this chart, as I'm sure you'll be well aware. Bank rate in the UK, but also interest rates, central bank interest rates in the euro area and the US have shot up since the beginning of 2022 in response to the big increases in inflation that we've seen off the back of the invasion of Ukraine by Russia. So big shocks to energy prices, big shocks to food prices globally. So in response to which interest rates have risen. And they've kind of plateaued in recent months. We've been holding them in the UK at 5.25%. And now the markets are assuming that rates are going to start falling. So, the curve on the right, the solid line, is where the markets think interest rates are going to go over the next 3 years. And you can see in the UK that they're predicting that we're going to get down to more like 3% by 2026. And that's not an unreasonable outlook for interest rates, we think. Though I should emphasize that we don't forecast interest rates ourselves. That would be a bit circular. We take the market's view and we plug that into our forecast. But that's the backdrop to our forecast. We've been raising rates very rapidly from an extremely low level in order to lean into the strong inflationary pressures that have been hitting the UK economy. Next slide, please. So the good news is that inflation is now coming down. So as you can see on the left here, we've had big shocks to inflation from electricity and gas prices for households in the orange bars, food costs in the purple bars, and also those light blue bars, other goods which are largely imported. So big shocks, external shocks to UK inflation, taking us massively over our 2% target, peaking at 11%. But since then, that inflation has fallen back fairly rapidly. And going into this year, we're expecting actually in the short run that we get back to 2% pretty shortly. And that's because those orange bars are actually turning negative. You'll see they've gone below the line going into 2024. So actually household energy costs are actually falling year on year going into 2024. So that's pulling down on inflation. I should emphasize, of course, that doesn't mean that the level of prices is that low. It's still massively much higher than it was before the invasion of Ukraine. So there's still real pressure on households' budgets and on firms' costs from that high level of prices. But the rate of growth of prices, the inflation rate, that's coming off, fairly strongly now, back down towards our target. So that's the good news. But as I'm an economist, I have to give you bad news as well, I'm afraid. And the bad news is that there's still persistence, underlying persistence in inflationary pressure. And that's the yellow bars on that chart on the left. That's the service sector inflation. And you can see that consumer services price inflation has been pretty steady and relatively high. And that reflects the fact that they are struggling with rising labour costs. They've had rising cost pressures, rising energy prices themselves, and they're trying to pass those through in order to sustain viability, sustain profitability as businesses. So we're seeing that kind of sustained underlying pressure on inflation. And you can see that also in the right-hand chart. I apologise that the colour scheme's different there. But the light blue line there is service sector inflation. If you read across to the left-hand axis, you'll see that's currently above 6%. And even in our forecast, we're still expecting it only to come down to just above 4% by the end of this year. And that's not really consistent. with 2% inflation. So the bad news is that whilst we expect inflation to come down to 2% in the short run, we then expect it to pick up a bit in the next year or so with that underlying persistent inflationary pressure, which is why, as of yet, we haven't started cutting interest rates. Next chart, please. Next slide. Thank you. So this is our forecast for inflation that we published beginning of February. Next one's coming out the beginning of May. So you can see the spike and then the fall back. And then in our central projection, the dark orange bar in the middle, you see that it kind of picks up again in the second half of this year into 2025 and then starts easing back in 2026 back down to target. And just to remind you, that's based on that market curve for bank rates coming down to 3%. And that curve really matters, actually, because if you just held interest rates at 5.25% over this forecast horizon, then inflation would drop well below target over that period. It'll be getting down towards zero if you held bank rates at 5.25. So that's really the challenge for the committee is, where to pitch bank rate decisions going forward in order to get a nice smooth path back down to 2%, not overcook it, get it too low, but not let inflation persistence get built into the system. And this is the ongoing struggle for the committee. I mean, just to say, of course, that we've got a distribution of possible outcomes around that central projection. So it's upside and downside risks to inflation. So you can think of the upside risks are largely around geopolitics. For example, you've got what's going on in the Red Sea, the difficulty of shipping there. That's leading a lot of shipping to go around Africa. That's slowing down supply. That's increasing costs for businesses. And there's potential for more geopolitical risk to crystallize. For example, events in the Middle East could lead to much higher rapid rises in oil prices, for example. So those are the upside risks. But then on the downside, it could be that we get increased uncertainty, we get lack of confidence, and therefore economic growth is weaker than we're forecasting, and that could drag down on inflationary pressure. So there's always all those risks for the Monetary Policy Committee to consider. Next slide, please. And this is our forecast for growth in the economy. Don't worry, we haven't misdrawn this chart. We've consciously cut the top and the bottom off the trough and the peak in annual activity growth in the UK because of the pandemic. So obviously in the pandemic, activity collapsed, and then just through mathematics in the following year, the annual growth rate shoots through the top of the chart. But if we include those peaks and troughs, then you can't really see our forecast going forward. So we've cut them off. And this is the forecast for GDP growth. And this really matters for inflation, obviously, because inflation at the end of the day is all about the balance of demand and supply. And if demand in an economy is growing faster than the supply capacity of that economy, then prices will rise and rise rapidly. So we need to have a view on where we think demand in the economy is going. And this is our best estimate as things stand. As you'll know, we had a technical recession at the end of last year, so 2 quarters of negative growth. But, they're very small negative numbers. And in practice, whether it's minus 0.1 or plus 0.1, that's very weak indeed and feels pretty much the same for anyone on the ground. What matters is that we have a very sluggish outlook for activity in the UK over the next year or two. It really only starts picking up in the third year of our forecast when we see a bit more investment growth by businesses and also consumer spending growth. So a very soft outlook for the economy. And part of that pickup, of course, is helped by the fact that we're assuming that interest rates will fall over this period. And why is that? Why is the outlook for growth so weak? Well, it's partly because the outlook for global growth is pretty weak. So we're not expecting trade to save us. It's not going to, global growth is not going to pull us out of this stagnant period. I mean, it's true that the US is doing better. You can see some pickup there. And that's a positive. That's 10% of our exports. But our major trading partner is still the EU, and the outlook for growth in Europe is pretty subdued at the moment. So we don't expect much growth there. And then, as I said, you've got all the geopolitical risk, not least around concerns about the Chinese economy and its overheating, property market difficulties there. So, the outlook for global activity is subdued. Next slide, please. So what about domestically? What about looking at the UK economy? Well, these are the three major components of activity in any economy, certainly in the UK economy: consumer spending, business investment, and government spending. Next slide, please. So in terms of consumer spending, where are we? Well, the good news there is that salaries, incomes are now growing faster than inflation. So inflation's come down. Therefore, most people are having wage growth above inflation. That's the good news. That should help to support some consumer spending growth. So we're expecting consumer spending to grow, albeit slowly, going forward. Because on the other hand, what people are also doing is looking to rebuild their savings. A lot of savings were built up during the pandemic, but they've been run down since. And a big question about where you think the economy is going over the next few years is the extent to which you believe that households will wish to build up savings for precautionary reasons because interest rates are relatively high, or whether you think that households will go out and spend because they're seeing a bit of income growth again, real income growth. And that's a live and open debate. And it'll partly depend, I think, on consumer confidence, which depends on a lot of factors, not least political ones. But it'll also depend upon people's expectations for where inflation is going in the future and where interest rates are going in the future. So if we can convince people that by our actions that inflation is going to come down and therefore bank rate is going to start coming down, hopefully that'll be a virtuous circle, and that'll actually lead people to start spending a bit more and maybe asking for lower wage growth. So we shall see. I think we have pretty weak consumer spending growth penciled in for the next 2 years, and then in the third year it starts to pick up a bit with that lower level of bank rate. Next slide, please. Then we come to business investment. Business investment is typically a bit lumpy and volatile. So it was quite strong in the first half of last year, for example, because of aerospace. But looking through all that, the confidence in UK PLC is relatively muted. There's high amounts of uncertainty. Interest rates have been relatively high recently. So all of that has helped to dampen business investment sentiment. When I speak to businesses now, they are doing essential investment. Some of them are doing a bit of investment here and there, but also there's a lot of stuff on pause, waiting, anticipating a bit more certainty about the economic and political outlook, and also this, expected softening in interest rates in the second half of this year. So again, very similar to consumer spending, we're not expecting much growth in investment, if any, for the first year, maybe a little more in the second year, and then some more in year 3 of our forecasts into 2026. Next slide, please. And then finally, we've got government spending. I'm afraid, it's a bit too close to the recent budget for me to have any kind of strong views about whether that's going to impact on economic growth substantially. But certainly the announcements that were made back in the autumn, they do have a positive impact on growth over the next 3 years, maybe 0.2, 0.3% improvement in activity growth. Cuts in national insurance that were announced back then, improvements in tax allowances for business investment, and a number of welfare measures. But, and it is a massive but, I'm afraid, all of that somewhat pales into insignificance compared to the fact that the huge amount of stimulus that was put into the economy during the pandemic, and then to support households and businesses with their energy bills following the invasion of Ukraine, all of that support is, starting to wane, starting to pull back out of the economy, and that's going to outweigh the other announcements by government. And so it does mean that government spending growth is going to be pretty subdued, pretty weak throughout the forecast horizon. And I should just emphasize that that's not us taking a view about what we think is going to happen to government spending. That's just us taking the government's plans as announced and feeding them into our forecast. We don't forecast government spending. We just take what they've said they're going to do and plug it into our model. As you can imagine, we have to do that because it would otherwise, be difficult to talk about these things running up to a general election. So that's what we do. That's our working assumption. Next slide, please. So overall, I'm afraid that means that the outlook for growth in the UK economy is pretty subdued. Big improvement in household spending and business investment towards the end of the forecast. You get up to about 1% growth by the end of the forecast for the UK economy as a whole, but that's very weak historically. Historically, annual growth in the UK, kind of certainly pre-financial crisis, was getting on for 2%. So this is not good news, I'm afraid. Next slide, please. So the question then for any economist is, okay, we know the demand side of the economy is going to be pretty weak. What's happening to the supply side? Because if you've got demand growth, you've only got one part of the story. You need to know whether supply is growing as well in the economy and how fast. And that's trickier to measure, to be honest. But in the kind of 3 years we're looking at, then supply is really all about labour supply. Obviously, there's more to it than that in the medium term, much more to it. It's all about capital stock. It's about the equipment you've got. It's about the infrastructure you've got. So all of that stuff really matters. But in the short 3-year window we're looking at, that isn't going to change a huge amount. Whereas what can change a lot is labour supply, which is the other component of supply. And as you'll all know, the labour market has been really tight in the past few years for a combination of a whole string of different factors. Most recently, the kind of long shadow that COVID has cast over, the working age population in the UK. So all those factors have meant that the amount of people available to work has been pretty low by historical standards. We've had high levels of vacancies, and a low rate of unemployment. That's meant it to be really difficult for people to hire, for businesses to hire, and wage inflation has been correspondingly high. We're not expecting that to change massively in the short run. As you can see here, this is our forecast for unemployment. It does pick up, but it picks up relatively gradually, and it gets up to about 5% by the end of the 3-year period. So higher than it is today for sure, but not exactly, not worryingly high by historical standards. And that pickup in slack in the labour market, that kind of freeing up a bit of the labour force, should put downward pressure on wage inflation over the next 2 to 3 years as labour availability improves. So that's one of the key reasons why inflation starts to come down over this period, despite the fact that we'll be cutting interest rates if you believe the market forecasts. Next slide, please. So this is various measures of wage inflation on the left here. And as you can see, they have been pretty high, not surprisingly given that tight labour market and also the massive cost of living pressures there have been on households, which have led people to want to bid up their wages. So that combination of an inflationary shock plus a tight labour market has led to this wage inflation. And partly, keeping interest rates higher for longer is about squeezing that wage pressure out of the system, because that has to be passed on in higher costs by businesses. Otherwise, they're not going to be viable. So we have to lean into that. The good news is we're starting to see wage inflation come down already. The official data are in the blue line there. The blue diamonds are our forecast for what happens through the rest of the year. And big picture, we're expecting wage inflation of around 5% this year in the private sector. Some indicators might suggest there's some downside risk to that. Some suggest there's a bit of upside risk, not surprisingly. So lower than we were, but still 5% wage inflation is going to be difficult to square with a 2% inflation target. So as I say, the hope is that as the labour market supply eases a bit and headline inflation comes down, we'll see further easing in that inflationary pressure going forward. And you can see that in the projection on the right, where in the blue line you see that wage growth does fall over the forecast period and eventually gets down to closer to 3%, which is pretty much consistent with the 2% inflation target. From my point of view, from a nerdy economist point of view, the interesting thing about the chart on the right is that the blue line is above that big grey swathe, and the big grey swathe is what you get if you just plug the data into a load of traditional economic models and say, what do you think is going to happen to wage growth? And the models give you the grey swathe. And so why do we think that wage inflation is going to stay a bit higher for a bit longer? Well, it's because those models are using historical data. And the historical data they're using doesn't go back that far. It goes back, a few decades, but it doesn't include the kind of massive cost shocks that we've experienced in the recent past, in the past 2 or 3 years. And those shocks, we think, are likely to lead to more persistence in higher wage inflation because people will want to try and regain some of their lost spending power over the next couple of years. So there'll be a persistence in higher wage inflation as a result of that. But again, these are all working assumptions, and we keep a really strong eye on the data to try and get a sense of whether these things are coming to pass or not. Next slide, please. So hopefully I've given you a flavour of how we make our decisions about interest rates. We have to look at what's going on in demand in the UK economy. As I said, the outlook is fairly subdued. We're not going to get much help from global growth. The consumer and businesses are going to be relatively cautious in the near term about spending, given uncertainty and the cost pressures they've faced in recent years. But hopefully we get a bit of a pickup by 2026. And what does all that mean for inflation? Well, we think that there'll be a bit more labour supply coming through by the second half of the forecast. That means wage inflation will start to ease, especially as inflation expectations start to ease back. And with bank rate coming down, all of that helps to feed into a world where we have inflation back at target sometime in 2026. As I say, it'll probably dip down to 2% at the beginning of this year, but then it'll pop back up again as the energy price components, the big shocks, wash out of the calculation. So that's where we are. In terms of bank rate, if I could just have the final slide, please. Yeah, that's the summary. I always like to end, though, with this chart because it just reminds everyone, or in some cases informs a few people, that 5.25% bank rate is not historically that unusual. And what's unusual is the period we've seen since 2008, with incredibly low interest rates over that period, which have been sustained by a series of shocks to the economy, which has meant that we haven't really been able to get rates back up to what you might think of as a more normal level. So prior to 2008, yes, 5.25% is restrictive. It's definitely leaning into the economy. It's meant to be trying to get inflationary pressure out of the economy. So 5.25% is not neutral. It's tight policy, but it's not highly unusual. It's a kind of, if you like, it's a normal tight level. So I don't know if Paul was going to ask me this, but often people ask me, well, where are interest rates going to end up? And it's a lively debate within the bank, actually, as to precisely what number you're looking at as a kind of neutral rate, not too hot, not too cold. But we know what it isn't. It isn't 5.25. 5.25 is tight, and it isn't 0.5 either. 0.5 is unbelievably loose. So it'll settle back down, somewhere between 2 and 4%. Will turn out to be a more neutral rate for bank rate in the medium term would be our assessment. So don't expect interest rates to go down to 0.5 anytime, unless we have some horrible negative shock to the economy yet again. So what we do in the near term, the Monetary Policy Committee will be looking really hard at what's going on in the labour market. Is it continuing to loosen? Are we getting a bit more slack, which is taking inflationary pressure out? So what's happening to wage growth, and therefore what's happening to that outlook for consumer services prices that I emphasised at the beginning, where we're concerned about persistence. So as you may have spotted, we had a three-way split on the Monetary Policy Committee last time. Two members were very concerned about that persistence in inflation, though they were voting for a rate rise. One member of the committee was much more concerned about the weak outlook for the economy, and they voted for a rate cut. And then the majority in the middle, 6 members, and they felt that 5.25 was just about right for where we are at the moment. So they voted to hold rates, and that's where we are at the moment. So you can move on to my final slide, please. And I'll be happy to take any questions that you've got for me, Paul, as a result of all that.
Thank you, Graeme. That was very, very interesting and informative. So, I mean, at Jerroms Mortgage and Finance, our key objective is to arrange loans and mortgages for business and personal clients. Now, our buy-to-let client base in particular, they've felt the impact of rising interest rates over the past 2 years, with volatility affecting the availability of mortgages. How do fluctuations in interest rates influence demand, affordability, and investment dynamics within the property market? And what are the potential long-term effects on house prices?
Well, I mean, yes. If I had a really good forecast for long-term house prices, I probably wouldn't be sitting here, would I, Paul? But I'll be a rich man. But they do, obviously they matter. They matter a lot. And the market outlook for interest rates, the fact that it's falling at the moment, has already led to, as I'm sure you're aware, a softening in mortgage rates, which themselves obviously are set off longer term interest rates in the markets. So it's a bit of a dark art, a bit of a mystery how the movements in the short end, in basically overnight interest rates is what we set, how they then cascade through to long-term interest rates. But broadly, if the markets think that short-term rates are coming down, then the long-term rates tend to go in that direction, and that's what feeds through to mortgage pricing. So mortgage pricing has eased from highs. I know there's been a bit less competition in recent weeks, but all of that makes these decisions more difficult, doesn't it? As to how affordable is it to take out a mortgage? How affordable is it to run a buy-to-let portfolio if you've got debt in there? At the margins, that's going to increase rents for sure. We're seeing that. The rental costs are going up. We've also seen house prices. They went up, but then they've been flat. Again, I'm probably not telling people anything they don't know already. I mean, there's a bit of movement, but broadly, house prices have flattened over the past 9 months or so, which from our perspective is a bit of a kind of sign that there's not going to be a huge amount of consumer spending growth, because house price inflation tends to be correlated with consumer spending. I mean, big picture, we would say that what really matters in the housing market, though, more than interest rates, is supply. It's a lack of housing supply that's the key driver of sustained house price inflation and sustained rental inflation in the UK economy. And until something is done about the supply side, we're going to continue to live in this world where there's a tightness of supply, therefore prices are high, and therefore there's high sensitivity to our interest rate decisions, unfortunately. Hopefully that gives you a bit of a flavour of where we're coming from. I don't know if that answered your question.
Yeah, I think it does. Thanks, Graeme. And I mean, just on the inflation side, as you pointed out, that seems to be going in the right direction and heading to be under control towards its 2% target. I noted that Andrew Bailey, the Bank of England governor, made a comment saying that you may cut rates before it hit the 2% target. And just more a point of curiosity, how much consideration does a bank give to the fact that there's a general election potentially within the next 10 months as to when they're making a decision on interest rates?
So just on the first point, yes, I mean, you don't wait till you've got to 2% to cut interest rates because as I said at the outset, the decisions we make today don't affect the economy today. They affect the economy in 6, 12, 24, 36 months time. So you need to be trying to look forward all the time and say, where's inflation going to be over that time period? You can't wait for it to get to 2% and then react because you'll be too late. In terms of the general election, we do and we don't. As I said, we just take government spending plans, feed them into our forecast. We don't take a view about whether those plans are going to change, either under whatever administration comes in at whatever time, and we just take what we're given. To the extent, though, that there is uncertainty in financial markets, there's uncertainty amongst businesses and households as a result of the fact that there's general election this year, then we try to factor that into our thinking because it's part of what might be holding back consumer spending and business investment, for example. So the uncertainty caused by a general election is kind of in there, but not any specific views about what might happen in the policy space, because judging that is very tricky. I have to say though that most businesses I'm speaking to so far say they've been relatively surprised by the lack of impact of general election uncertainty on decision making. There's maybe been less than they might have expected.
Understood. Yeah. Okay. I'm just on the employment side as well. What extent do you anticipate the integration of artificial intelligence technologies or AI, and how will it shape the employment landscape and changes in job creation? I mean, do you think it's necessary to address that in advance?
I mean, it's slightly outside our remit, to be honest. I do speak to a lot of businesses about potential productivity gains from AI. There's a lot of talk about it at the moment, but few hard examples of where it's having a major impact. Yes, it makes things easier to draft, perhaps, but there's obviously massive potential, and I think we'd be daft to ignore that. It will lead to people being able to put more basic work into an IT system. A lot of kind of matching of invoices or just looking through large amounts of legal documentation, all that kind of stuff. You'll probably still need a human being at the moment sense checking it, but you won't need teams of people to carry out the work. So that ability to deal with huge amounts of data very rapidly is going to change the employment landscape and move people up the value added curve in the same way as has happened with automation in manufacturing. It'll affect the service sector, and we already hear of some impacts in copyright, advertising, copywriting and stuff, that it is having an impact at the margins. But it's very much a watch this space. It's moving really rapidly. Right. Having said that, it's not in our forecast as such. We're not expecting a massive productivity boost in the next 3 years as a result of AI to kind of create an economic miracle in the UK. Sadly, I mean, that'd be great if that were the case.
Yeah, and I mean, just on that, with demographic shifts such as aging populations and changing workforce dynamics, I mean, how does that influence long-term economic growth?
I mean, that's a good question. I mean, one of the problems we have at the moment, Paul, is that the official statistics on the labour market have been really badly affected by the pandemic. So the Office for National Statistics traditionally collected data on the labour market by going out, knocking on doors and undertaking a questionnaire. And that labour force survey was really good, really robust, really strong data. But of course, the pandemic meant they could no longer do these face-to-face interviews. They switched to telephone. The response rates collapsed. And as a result of that, the data are questionable and they've become much more volatile. So we're kind of doing this a bit with one hand tied behind our back. It does seem to be the case that there's been an increase in what's known as inactivity. So fewer people of working age actually searching for work or in work. So you're either if you're searching for work, you're unemployed. If you're in work, you're in work. But then there's a whole bulk of people who are working age, but for one reason or another are not looking for work. That's always been the case, but that's shot up obviously during the pandemic due to long-term sickness, and that seems to have been sustained. So that is a concern if that were to continue, because that's just a pool of labour that we don't have access to anymore. And then with demographics, yes, if you've got an aging population, likewise, you've got a lower proportion of working age population. They've got to do more in order for per capita, per head GDP to continue to grow. Because the likes of you and I will be retired in a few years, and expecting them to support us in the life to which we wish to become accustomed. So
absolutely,
yeah. So that's certainly a challenge it's a challenge for most Western economies, to be frank. And is AI the answer? Question. There's you get into politics very quickly if you're not careful. So I think I'll probably leave it there.
Okay, I mean, moving back to central bank issues, perhaps in terms of digital currencies, the adoption of central bank digital currencies or CBDCs, how do you think that will reshape the traditional monetary policy framework?
Well, that's a massive question. There's a lot of, if people are interested in central bank digital currencies, there's a lot of really good stuff on our website on that. And there has been big public consultations which kind of come round on a regular basis, so people can get involved. I mean, the hope, of course, would be that it doesn't change things fundamentally, in the sense that we're still setting interest rates in order to hit an inflation target, and that the means of exchange being digital and at the central bank doesn't change things, the same way as the change, so rather than, already people are not using as many notes as they used to for transactions. We're all using our phones or our plastic. So in many ways, money's gone digital already. And the majority of money, just to be clear, is not banknotes. The majority of money is electronic. It's in bank accounts. That's where most money is. Having said that, of course, that's not quite the same, because we know notes exist. We know that we can go to our bank and draw out banknotes, and we know that they are backed by the Bank of England and implicitly, therefore, by the UK economy, by the UK as a whole. And that's what you want to replicate with the CBDC. You want to have a digital currency that is actually, backed by the whole of the UK economy, not just, backed by, whichever payment provider you happen to be using, whether that's PayPal or Google or, or one of the or a high street bank or whoever. It all relies on there being an underlying currency that is backed by UK PLC, and that's what we're trying to replicate. We would try and replicate in the digital space rather than being a plastic note. And the question is, how to do that most efficiently and in a way that people trust. Because as we right back at the beginning, it's all about maintaining faith in money. It's all about maintaining trust in money. So you've got to do it in such a way that people trust it and they don't think that there's anything wrong with it. I just would add to that we are completely committed to maintaining cash availability in this economy for as long as everyone wants it. So we're working quite hard to make sure there aren't, that we do something about the fact that certain kind of cash deserts seem to be opening up where people can't get to an ATM that's free to use and draw out cash. So that's still an important part of our remit. There's no policy to kind of get rid of cash at all. It's just having other things at your disposal so that everyone's got options.
Yeah. Thank you. Interesting. And finally, I'm just with an eye on the clock. One final question: what do you perceive to be the most significant future challenges for the UK economy, considering factors such as demographic shifts, technological advancements, globalization, environmental sustainability, and what policies could we put in place to assist them?
I mean, that's a massive question, and to be frank, it's not a question for the Bank of England as such. I mean, the biggest challenges for us are trying to get inflation down to target in a sustainable way that doesn't lead to unnecessary economic hardship for anyone in this country. That's what we are trying to achieve. I mean, if you speak to economists, you'll probably get different views about, you've listed, that was a good list, of challenges, and
Yeah.
some economists have put more weight on some things than others. I think one thing we are looking at quite hard is productivity growth and how weak that has been in the UK since the global financial crisis. And that is a concern, because without productivity growth, it's very difficult to get sustained long-term economic growth back at a level that you'd want to see, irrespective of all the shocks we've experienced since then. So trying to drive productivity growth is a key challenge for our economy and for Western economies as a whole. And again, if you speak to different economists, you'll get different prescriptions as to what the best way is to achieve that productivity growth. But if you ask me to name the biggest challenge, that'll be it, because without that, we're not going to get the sustained growth we need to improve the living standards for everyone.
Okay. No, Graeme, that was very informative. Thank you very much for your time, and thank you everyone for dialing in. And we'll be releasing a recording in due course.
Thanks, Paul. Thanks, everyone.
Thank you.